cap index, which lagged a little bit as well. And I think there as well, there should be gains, 1% of the small cap index. I mean, the small cap index at almost the low had corrected from the top about 17.5%. And as of yesterday's close, it's down about 14. So the recovery has been a little muted so far. Will that catch up as well is the question. Lots of stuff opening up and banks, lots of banking gainers as we are highlighting at the bottom. Surbhi.
Okay. The oil refiners are quite happy this morning, I must say. BPCL is the big winner on Nifty, 3% higher, but it's not alone. Check out HPCL and IOC. Those stocks are also up between 2.5 to about 3% So that's a good space. And at the same time, ONGC is also doing well. So you have downstream, upstream, everything doing well this morning in oil and gas. That's one trend. IndusInd Bank is the third best performing stock on the Nifty, 1.5% higher. There's some gains on Shriram Finance, on Hindalco, on Power Grid as well. And then it gets a little quiet. The Nifty is just about trying to defend a 30-point gain. The Sensex has already dipped into the negative territory. Trent is trying to recover a little bit after yesterday's big, 7% dropping. It's about 1% higher as of now. There's a little bit of buying in technology. TCS Infosys up about 0.5%. Wipro is up about 0.5% as well. On the downside, Asian Paints, like I said, the market's just, still not, able to get over the kind of performance and the commentary that's also come through. It seems that recovery is still some time away. 4% down there. Nestle is lower, Titan's lower. Manglam explained to us that there is an inventory issue, which is why you have the pressure on margins. But even then, I mean, at first glance, it's bad, and the market's reacting to it. Tata Consumer also on the lower side. Britannia is also lower, Lever is also lower. So the consumer selling that we saw yesterday, that's extending into this morning. But to add to it, you've got L&T lower, you've got, I think, Reliance also lower. So a couple of these heavyweights not feeling too well this morning.
Well, that's right. And a few stocks that are actually bucking the trend. You have MTNL that's flying away, a couple of other notable ones. I think BEML's land assets as well. That's the one that's separately listed. Both of them are moving on very, very high volumes. I think there are a couple of news reports that indicate that the government could look at, selling some of this land that belong to these companies, MTNL and a couple of other, PSUs. So that's why, in fact, you're seeing these stocks up. The reason that the OMCs are up is because Goldman Sachs, they have upgraded the stock. They are taking on both that there is an earnings risk driven by lower crude discounts as well as LPG under recoveries. But they're saying that most of these concerns are in the price. So that explains why all these three stocks are moving very, very well. Bharat Bijli, I think it came out with a set of numbers yesterday. It was up close to 20%. Today as well, that stock is up close to around 8%. So good move is what we're seeing on that one. Birla's Corporation, that's a cement company in there. That one, in fact, came out with a set of numbers that looked weakish, but the commentary was positive. And now the street is buzzing with excitement that a couple of these price hikes that are pushed through yesterday, even day before, there was this talk of a price increase, that bulk of it will be pulled through. So that explains why that stock has moved up. Prism Johnson, that's the other one in there. The reason that the stock is mildly higher is because they've sold a land parcel to JSW Group for around 160 crores. The debt in their books is around 1,200 crores. So that's why that stock is opening up mildly in the green. A good start to trade. The Nifty is doing well, but keep an eye out on the broader markets. Those boys got battered. Well, it seems they're in the mood to fight back.
Okay, on Asian Paints, by the way, Prashant, before I toss it to you, CLSA has put an underperform and their price target is 2047. I think that view could be, leading to the additional weighing down on the stock. 4% biggest Nifty loser. So that's CLSA sounding circumspect on the recovery prospects.
Absolutely. And, we'll keep a track of that as we go along. What else? I mean, I don't think there's very much else which is going on. Actually, there is a fair bit going on. Let's just look at a name which we don't usually refer to at all in the morning. E2E Networks, right? It's one of those stocks which basically fell more than, I think it fell 60% from the highs. And I'm only mentioning it because it's, I think, the number 5th or the number 6th volume traded stock on the NSE. Non-stop downside. The definition of you can't get out. From 5,500 fell to about 2,200 yesterday. And today it's reversing a little bit, about 190,000 shares on E2E Networks. BPCL is up 3.5%. I mean, the BPs of the world fell quite sharply yesterday. And they're coming back up a little bit. Amber is the biggest volume-led gainer. It's up 4%. And there is Angel One, which is up with humongous volumes. It's up about 4.5% right now as well. Yeah, I mean, Religare is another one, right? I mean, that open offer, the Burman open offer, etc. 2.5 odd higher. MCX is up. Somebody was mentioning that in the morning. 3% in the green. Titagarh, Triveni Turbine, and so on and so forth. As things stand. 20 points on the Nifty. Pratik Gupta is our market master there, CEO and co-head at Kotak Institutional Equities. Pratik, good morning. Good to have you back on the program. Thanks very much. The question to you is, of course, I mean, to assess the color, the intensity, flows, and what should we expect from here? Because yesterday, foreigners net bought in the cash market after some time. Do you think we've seen the worst of all of the selling, and whether we should expect sort of limited selling, if that, or maybe even some buying from here on? What's your sense?
Hi, good morning, Prashant. We think yesterday was more of an aberration, more due to short covering rather than real long-only global active funds coming back to buy India. I think at Kotak, when we speak to most of our global investors, they're still very, very cautious. Most of them are seeing they still see India as quite an expensive market, trading at 20 times FY26 earnings on the Nifty, trading at 100% premium to the MSCI. And more importantly, India is a growth market. People come to India for growth. And growth is where I think we've been disappointing last few quarters. And even the outlook going forward isn't that great. We're at Kotak, we cover almost 300 stocks, and we're more worried about the risk of earnings downgrades rather than seeing any strong case for earnings upgrades in the short term, at least. So the long-term structural story in India stays intact, but most foreign investors are seeing money going back to the US. And this Trump tariffs and trade wars are actually just injecting a lot more uncertainty, flight to safety, which is back to the US dollar. So until we see signs that the US dollar is weakening, until we see some noise around this trade wars sort of coming off, I think we will continue to see foreign selling, and the market will continue to be driven more by local flows. So sort of you may see a tactical bounce, but otherwise we're still advising a cautious stance on the markets right now.
Okay, cautious in the market right now. By the way, I'm just sort of updating, since I was talking about Asian Paints earlier, it's not just CLSA. A whole range of brokerages. There's almost an overwhelming consensus on the way down on Asian Paints, and something like a Jefferies as well has lowered the target. Jefferies is now at 2,000 on Asian Paints, and most of these targets are running well below the current market price as well. So it seems the pain is playing out. But Prateek, let's actually, have a broader discussion on consumer, because it's very clear that there is this personal income tax bonanza that's come our way. The question is, how can it be captured from an investor standpoint? What kind of stocks would you look at? For instance, would you look at buying into weakness in a stock like Titan? I know you won't name individual names maybe, but in general, how would you play the consumer where you see some element of growth and some element of valuation comfort as well?
So I think the main point is the valuation comfort, which you highlighted. That is still not there in most of the consumer stocks. And despite this tax bonanza in the budget, just keep in mind that this amounts to barely 0.3% of GDP. And not everybody who gets that extra 1 lakh rupees or whatever tax savings, they're going to spend it on consumption. Some of that money will be saved and invested and so on. So it may not necessarily flow into consumption, although nonetheless, this is a good step. This will result in some boost. But we think it's unrealistic to expect that the top 5% or 10% of the population, which is really who will benefit from the tax breaks, they will start buying more of soaps or shampoos or buy more milk. In fact, we had Nestle's results yesterday, and Nestle's more in the premium staples category. But even they were highlighting what the weak demand environment. You saw Asian Paints again pretty weak. So we think it'll be the low ticket, small ticket discretionary items which will benefit because staples, I don't think you'll see a demand boost. On the other end of the spectrum, we may not see a demand boost for let's say, high-end discretionary items like jewelry, etc. I think it'll be more the low-ticket discretionary consumption. It could be QSR, it could be mid-size, mid-class hotels, small tourist type of. You could see a pickup over there. But overall, I wouldn't read too much into the budget boost. We are still going through a weak growth phase. The jobs addition is still low. The quality of jobs and the wage growth is still quite weak. So we think we are more at risk of seeing downgrades in most consumer stocks earnings over the next 1 or 2 quarters. And therefore, we'd still be somewhat cautious on the overall consumer pack.
Hi, Prateek. Good morning. Good to see you in. Prateek, what about these OMCs? It's not the one for the faint-hearted, but the stocks have corrected big time. Crude oil prices was being volatile. You had the LPG subsidy as well that wasn't as much as expected. And those stocks have seen a sharp correction. However, this morning we have Goldman Sachs has come out with the note, and they are saying that they believe bulk of it is in the price. Your view on the OMCs?
So I think it partly depends on your view on the oil prices. So there we think oil prices will stay high, which is why we actually prefer more the ONGCs of the world rather than the OMCs. The OMCs are also subject to all kinds of regulatory intervention. There's a lot of heavy capex going on as well. So from a free cash flow perspective, these and the ROE, sustainable long-term ROE perspective, we are still quite worried. These are more like trading stocks, the entire oil and gas pack. But at this point in time, instead of the OMCs, we prefer ONGC at this point in time.
Got it. What about a couple of those other sectors that did very, very well when the broader markets were doing well? The renewable energy space, solar themes, they did very, very well. And they have seen a fair bit of a pullback from the top. What's the view on this theme? How do you play it?
So the solar theme is pretty interesting. We think there's tremendous long-term growth potential, but I think you got to be careful. We prefer the asset owners, the ones who are actually, you've got IPP contracts and building out solar plants, rather than the modules and the cells providers. There we think competition is likely to come in. There's a lot of capacity being put up. So in the next 1 or 2 years, you will see strong growth from those guys as well, but that's more than reflected in the price. I think the longer term story is going to be in the asset owners. And I'll just name one stock where we actually did an IPO some time back, and that stock's come off below the IPO. That's Acme Solar, for example. That's something, those kind of companies will do relatively better versus the solar and module providers. And then you have the integrated existing incumbents who are getting into solar, the existing thermal players, they're also getting into solar. But there we think valuations are still somewhat extended and there are pretty significant issues in terms of execution capabilities over there as well. So again, you got to be a bit more stock specific. You can't say, okay, the entire solar space is going to do well, so let's buy the entire pack. I think we'd recommend being a bit more cautious and look at valuations as well.
Okay. By the way, just looking at more active stocks this morning, and Angel One is very interesting. Angel One, let's pull up the stock. It's zooming up almost 6% higher. The monthly update has come in, and our colleague Vamakshi points out an interesting trend that the client addition is a little subdued. Month on month, client addition is actually down about 15%. But guess what? Volumes have started picking up. The average daily turnover, that's increased 6.3%. So it seems the market wants to believe that the worst of this change in F&O norms, all of that impact is now, played out, and maybe some semblance of stability gets back in. Prateek, so that question to you, the business that you're in, capital markets. The stocks have been such high flyers, right? The stars of 2024, but then we got into this patch where the market's not doing anything, regulations getting tougher. What do you think of them now? And if you were to play a capital market story, what would it be? It would be brokers, wealth managers, mutual fund companies. How would you look at it? So exchanges, of course.
Yeah. No, exchanges, I think generally are a good play. You saw the NSE numbers yesterday. But I think off the lot, I would say the AMCs or the mutual fund companies are probably the best bets. They have corrected quite a bit, 20-25%. In fact, today we've upgraded some of them. We had negative ratings on them until recently, but given the stock price correction last few months, we're turning a bit more constructive. I think the structural story is quite intact in the case of the AMCs. Firstly, you've got a growing savings pool in India. Second, more and more people coming into the equity markets. And third, these AMCs improving the distribution networks, coming out with more products, getting into passive themselves, passive funds as well. So we think valuations have now become a lot more reasonable, ranging from 20 times to 27, 28 times for fairly attractive, 15 to 20% earnings growth over the next 3 to 5 years. And with very strong ROEs. And the worst of the regulatory environment in terms of all kinds of changes in the last 1.5 years are behind us. Brokers, on the other hand, I think are more vulnerable. Depends on and the jury's still out in terms of what the volumes will be in the coming year. They're more dependent on the volume outlook. Also, regulatory changes over there are likely to remain adverse. So we prefer AMCs of the entire pack.
Okay, AMCs is your pick of the lot. Got it. Prateek, thanks very much. Good having you on the show today, and thank you for all the perspective. We look forward to the next call soon. Well, with that, let's dive straight in and talk about the retail trends that we're picking up. We've got, of course, quarterly numbers to report, to look at as well, and, of course, the overall environment. V-Mart Retail reported a pretty strong performance for the third quarter. There was sharp expansion in margins due to operating leverage. To talk about this and to give us an outlook, we have with us Anand Agarwal, CFO at V-Mart Retail. Thanks very much, Mr. Agarwal, for joining in. So I want to start right here. Top line growth of about 15.5%. Your margins have improved to about 16.7%. Let's talk about this. Is this growth coming, from the rural segment, tier 2, tier 3, or are you seeing some improvement in the urban demand as well? And what are the SSG trends that you can maybe extrapolate from the third quarter into the future?
Hi, Surbhi. So, yes, I think the performance has been pretty much robust all around. So it's not just the urban markets, but also the rural markets, which have done quite well for us. We present more in tier 2, tier 3 towns, and that is where the bulk of our operations are. And that is where we are seeing a lot of revival in demand. I think last 2-3 years have been pretty bad in terms of the rural recovery. But for the last, I think, 9 to 12 months, we are seeing strong signs of revival. So we are growing in almost all the geographies. There is strong momentum coming in from north and strong momentum also in the south. East has been slightly softer this quarter, but otherwise on a like-to-like basis, on a same-store sales growth basis, we grew at almost 10% across all the regions. So going forward, also, I believe that we should be able to maintain this growth momentum, and the like-to-like sales growth should remain in high single digit for the quarter 4 as well.
High single digits for quarter 4, which means on a full year basis, you will end same-store sales growth in double digits for sure, right? Because I think 9 months you're already at 12%. So this is not just a festive season-led bump up in Q3. You're expecting this to continue, going forward as well?
Yeah, that's correct. I think that's also a lot to do with a lot of changes that we have been doing in our own internal functioning in terms of efficiency improvement, in terms of how we source, how we select the product, how we design the products, and a lot of that is playing into also the tailwinds that we are getting from the markets. So there is a revival in the market, definitely. And there is also a lot of work that we have been doing, which is, yielding us results. And that's why I remain hopeful and optimistic on the road ahead.
So full year SSG, should we say, should be at least, 12-13% in that range?
That's a calculation, yes. So high single digit for quarter 4. And then I think the full year average should definitely be, double digits.
Right. Just margins, Mr. Agarwal. Hi, morning. Prashant here. What are target margins you're looking at? And when will Unlimited margins meet that of V-Mart?
So Unlimited, Prashant, has already, come to a very respectable level. In fact, the margins in Unlimited for this quarter were almost at par or slightly higher than even V-Mart. And that's probably happening because of a very calculated strategy wherein we are opening more number of stores in South India in a similar and exactly the same format as that of V-Mart. And that is a proven model that has worked for us in rest of India, and that is working very well for us in South as well. So all the new stores that we are opening in South are giving us very good margins, and therefore as an average, the Unlimited chain therefore is coming almost now at par, should come at par on a full year basis also in the next year.
Overall margin, Mr. Agarwal, what's the target?
I think we should still be, looking at around 12% or so EBITDA margins.
Okay. 12% EBITDA margins. LimeRoad acquisition, how far is the turnaround?
LimeRoad is still in a recovery phase. We are still trying to use and leverage that platform for more shifting the customer easiness and providing our own V-Mart customers as well as Unlimited customers are more easier access to bigger catalog. So the strategy there has been to cut down on the marketing spends and thereby improve profitability or improve the losses there, and source a lot of customer traffic from the existing and probable offline customer base. So I think we will still have little amount of losses in LimeRoad, but LimeRoad will still remain a small but an integral part of the overall network.
Okay, got it. So it's been good going for you, not just in Q3, so far in the fiscal, and you're sounding optimistic. And imagine this is without the personal income tax bonanza. So what happens from here on is the question. And to talk about this, we have another guest joining in. We have with us Akash Agrawal, whole-time director at V2 Retail as well. Akash, so that question to you. I think tier 2 or rural has not really been the problem. A lot of retailers, consumer companies are talking about the urban slowdown. To what extent do you think will this help your operations, this personal income tax cut?
So about 80 to 90% of our stores are in tier 2 and tier 3 towns. So that's where the bulk of our revenues come from. But there had been pressure both in rural and urban. So we welcome this move, and there was an urgent need for some kind of stimuli to boost customer demand and spending power. So I think it's a step in the right direction, and it has the potential to create some sort of ripple effect across the economy. Because when you have higher disposable income, it should stimulate consumption, and then ultimately it should fuel business growth. And hopefully it leads to a multiplier effect on employment and investment.
Got it. Gentlemen, of course, the whole idea about fast fashion or the tier 2, tier 3 category that you both have told us about is that to keep prices stable. And that's how volumes continue to fly off, right? So I want to get a sense on pricing from here on, and also the disruption that the industry perhaps will look at. Because from the online perspective, we have Shein now coming in, along with Jio, and we saw that disruptive impact play out on the trend stock just yesterday in the market. The market's wondering which way this will go. So Akash, again, that question to you. While the underlying demand continues to be strong, maybe will get stronger because of this income tax cut, what about price elasticity in the market? What about competition in the market, which is only heating up?
So talking specifically about Shein, I think it's an online-only model. And the pricing strategies and the average selling prices are very different than our business model. So what we focus on is strengthening our value proposition and ensuring that our customers get the latest trends. So I don't think they are in direct competition to us, or they might affect us significantly in a way. But there's always welcome for new players in the value fashion market, and I think it's good for the overall business and the market. Because people are focusing more on value fashion these days, as people look for affordable clothing, and even the frequency of purchases have been increasing. So I think it's good for the overall sector.
No, absolutely. I mean, and the thing is, the digital medium is also really catching up. Mr. Agarwal, your thoughts on this? I'm not sure if you're exactly in sort of what products would you be almost like competition with something like a Zudio. But there is a big challenger coming now in the online space, and a lot of your value-conscious customers are also checking prices online and looking at options online. So what do you think lies ahead in terms of the pricing elbow room that you may have?
I think, Surbhi, I fully resonate with what Akash said. And see, competition is always good for the market. And it also helps us, improve our own way of operations and looking at what best we can offer more to the customer. In any case, the product segment and the customer segment that we target is slightly different from the pure online segment. The core, customer base that the typical value retailers of tier 2, tier 3 towns have a slightly different taste. And we specialize in making sure that we are able to provide that kind of merchandise to that customer who has to make an investment decision. It's not just a buying decision for a pair of jeans or a top. It's more of an investment decision. Our experiences, despite being an online retailer as well for the last 4 years, the offline customer behaves very, very differently. But at the same time, we remain very optimistic on the entry of more competition. We've always had a lot of competition in the value retail segment. And it's not just the online retailers who are eyeing India for online entry, but it's also a lot of conglomerates which have beefed up their presence in the value retail space. And, even with all of this, I think still the unorganized market occupies almost 80% of the Indian retail apparel market. So there's a lot of room for growth for all of us. And I think if we pull up our socks, we do our strategy well, we should have enough room to play in.
Absolutely. And what we know right now is that, Shein will have mostly an online presence. And there's something very nice about going offline, walking into a store, trying on the attire and then making your purchase decision. So that's always, a plus. Thank you very much, both of you, for joining in and taking us through the trends in terms of consumer retail in the third quarter. Nigel?
All right. Well, let's get to the next stock, Titan. That's the one in focus that had a couple of one-offs in the past quarter. But what's the trajectory and how are things looking from here on? To help us out with that, we're joined by Mr. C.K. Venkatraman, the Managing Director of the company. Hi, sir. Good morning and good to see you, Ben. Well, let's start off with the largest part of your business, the jewelry business. Out there for the first 9 months, you've grown by close to around 26%. And margins, adjusted for a couple of one-offs, it's at around 11% approximately. What kind of growth trajectory you expect to continue on the jewelry business for this year? And is this 11% the new normal in terms of margins? Are there levers you have in store to push it a little bit higher?
Hi, morning everyone. The overall opportunity for the jewelry business of Titan is very strong. The brand and the set of brands we have are all much desired. Together we have at best a high single-digit share. There's an acceleration in the formalization of the category. The kind of customers we cater to are sitting in the top 1/3 of the income pyramid, and the long runway in the growth in the numbers of those customers, as well as their income and wealth, is pointing to a long, growth for Titan's jewelry business. The one uncertain thing in this is the price of gold and the fluctuation, and short-term fluctuation in the price of gold, like what is happening even as we speak. But barring that, the runway is very strong, so we expect to continue to do well over the next, many quarters and many years. Yes.
All right. I would appreciate if you could give us a number. Is there a number you look at? You can continue the current momentum, 25% growth because of formalization of the industry and the big potential. Should that be a fair estimate? And also, I wanted to ask you about the studded ratio. That's come down to around 23% or thereabouts. I recall you used to be at 30 plus. So a couple of questions out here. Where does this number stabilize at? And so much of talk about lab-grown diamonds, but I believe the risk to this particular category is only around 10% or thereabouts. Could you give us a number?
Actually, the growth which we typically look at every year is in the ballpark of 20% from an annual point of view. And that's the kind of thing that we would be satisfied with rather than continuing to maintain the 25 in every quarter. So that's the answer to the first point. On studded, actually the studded growth in quarter 3 has been very good. It's because of an even higher growth in gold and gold jewelry, as well as spectacular growth in gold coins has depressed on the face of it the share of it, just mathematics. And we are not really so much bothered about the share of studded jewelry as much as the growth in the studded jewelry category, as long as it is in a respectable level, which it was in quarter 3. We are okay if the share falls because it's the total scale of the business in such a situation that is rising rapidly, and the total gross margin in rupee terms that will rise and give the leverage for profit growth. And
so you're okay with it being, sir, in the early 20s, 22, 23% is okay for you?
I'm not saying that. What I'm saying is that is a result of the combination of the growth in studded, growth in gold jewelry, and growth in coins. We are very particular about the growth in studded jewelry. I mean, I'm just saying hypothetically, if the gold jewelry were to grow 50% in a particular quarter, despite the studded jewelry doing whatever we think it should be doing, the share will fall. But the total gross margin, the total sales will be much strong. That's the point I'm making. So I'm not saying we'll be satisfied with 20 or 22 or anything like this. I'm telling you why the studded share is low, despite the studded performance being on target and strong.
All right, Mr. Venkat. Right. No, got that. It's a function of how the portfolio shapes up. Good morning, Prashant here. On the margin front, sir, could you give us a sense? Is the new range between 11.5% Is there pressure broadly? Is there pressure here as you see it? And what could be the upside triggers really?
Hi Prashant, given the long runway in terms of growth and our having just a single-digit market share, our focus continues to be on sales growth and with a stable margin around that 11% ballpark. That's what I would gun for. That's what we are pushing for. And from an overall business performance point of view, the return on capital employed of the business, of the company, is very strong at this level of margin because of the overall capital turns of the company being at benchmark levels. So since we are a very well-performing company, we would like to focus on the sales growth while maintaining the margin in the 11% ballpark.
Okay, and on just a very brief comment on lab-grown diamonds specifically, you are the overall sort of leader. How are you seeing adoption rates in the, not just for you, but I mean otherwise as well, not just for the group, but otherwise as well in the industry? Is it very fast? Is it slow? Just a sense.
There's a lot of action, there's a lot of activity, a lot of brands, a lot of stores, a lot of visibility and all that. And I think in the early stages of any category, that visibility, that noise will sort of suggest a certain level of actual performance, which is not really on the ground like that, but that's okay. That's how it is. It is certainly a very important development in the jewelry category. It's a very interesting product. Titan's own strategy will be shared as and when we are actually ready to share it. But on the ground, even in concentrations where we have a lot of lab-grown, stores around us, we are not yet seeing any major conversation around the LGD. People are appearing to be more interested in reconfirming that, that they're buying naturals and all that, as opposed to actually wanting to buy LGDs. But honestly, early days, so I wouldn't.
Mr. Venkatraman, sir, morning, Surabhi here. But, if I could ask you to expand on that point, because now whether we're looking at the studded mix or whether we're looking at CaratLane, our colleague Maglam tells us that the growth has slowed down. It's at 27%, but it used to be much higher, the growth for CaratLane. Now, we don't know if this is a transient impact of some shift to lab grown or not. But my question to you is, A, on CaratLane, what would the expectation be? And the strategy that you said, that Titan will reveal the strategy in due course. When, sir? And my simple question is, why not also give the lab-grown offering? I mean, maybe once the customer walks into your store, instead of going to some A, B, or C lab-grown diamond, retailer, maybe you can convert them to naturals as well. Why let the customer, go anywhere else? Why don't get all the footfalls by offering even lab-grown and then trying to, upgrade and uptrade the customer? By when can we have that strategy?
On the first point, if you look at the performance of CaratLane, it's actually between Q3 and Q2. I mean, Q2 and Q3 have been rising. The overall profit performance of the brand has also risen. And we'll have to see the portfolio of, CaratLane is substantially in the less than 1.5 lakh price points. Mia, which is another strong brand of Titan Company, is substantially in the less than 1 lakh. Tanishq itself also operates. So we'll have to look at the total, between these three brands, the less than 150,000 price point, how well the Titan Company is doing. And that's something that we keep a track of, and we're very, very satisfied with these various parts. The lab grown is, your suggestion of why not is, most welcome. All I'm saying is that companies don't necessarily share what exactly they're planning to do before they actually do that, right?
No, how many quarters away are we? I mean, I'm not saying you're not going to announce it on national television. I totally get that. But how many months or quarters away are we from understanding what Titan is about to unleash here?
That's part of, keeping it close to the chest, isn't it?
Okay, I won't stress on that point. Let me come to the other statement that you made, sir. You were just telling Nigel, and tell me if my interpretation is right. Overall, when we talk about the jewelry business, gold, studded, non-studded, everything put together, you said 20% is a growth to expect. So, are you saying that from 25%, 20% could be the new normal?
If you go back and look at the growth rate of, the Titan's jewelry business over the years, we have been in that 20% ballpark CAGR for many years. So I'm saying if we do at this scale, if we do 20% CAGR for the next 2-3 years, for instance, I mean, that's a damn good growth.
But we shouldn't expect 25%. What I'm trying to understand is that we should then change that expectation from 25% growth year after year to 20% growth. Is that a fair understanding?
I'm saying that 25% is the growth that we delivered in Q3 of FY 25, right? Whereas you're asking me for future forward.
Yes, full year CAGR growth, full year CAGR. Yes, sir.
So I'm saying we had a 5-year or 3-year Titan turbo plan, which is in that 20% plus ballpark. So we'll be very satisfied at this scale to grow at that rate. That's all I was clarifying.
All right, Mr. Venkataraman, very quickly before we let you go, there was this buzz that Titan is on the prowl and you're looking at some inorganic growth. Can you clarify? Is there something domestically or internationally that you're looking at that we could hear about in the near future?
We're always looking at something or the other. And
what could the size be and how long, sir?
All in good time.
Before the end of this fiscal?
All in good time, like I said.
We have to wait for the lab-grown strategy, for the inorganic, perhaps maneuvers. We have to wait a bit, I think.
Okay, all right, Mr. Venkataraman. It's been good speaking to you. To be fair, I had visited your Titan store in Bandra and quite impressive with regard to the analog watches you all have as well. Everyone's going digital, but, some of those watches look quite good. So all the best on that front. We look forward to hearing from you on a whole host of those issues that we briefly spoke about. For the time being, we slip into a short break. On the other side, we'll get chatting with the management of Happiest Minds. Stay with us.
Okay, welcome back. 30 points on the Nifty. So 23,770 is where we are trading at. Happiest Minds is the next management of the show, where the company reported a soft set of third quarter numbers. My colleague Reba Tendulkar caught up with the company's MD and CFO, Venkatraman Narayanan, and Executive Vice Chairman and CEO, Joseph Anantraju, began by asking them about the quarter gone by and how they see growth going ahead. Listen in.
When we started the year, I had given a forecast or not a guidance of 30 to 35%. That was the number that we had given out in growth in constant currency. And that was assuming that we will get the full credit for the consolidation coming in from Pure Software, Aureus, and Macmillan. But, unfortunately, it took some time to close those transactions, and we only got about 40 days of the revenue benefit from those transactions. So that impacted us, and which we did highlight in the earlier quarter, considering that we will continue to try to see how we can make the 30% number, which is the lower end of the forecast that we had in terms of growth. Compared to that, we have done about 25%. I would also like to highlight that all the two quarters, which is Q2 and Q3, we have done 27 to 28% growth year over year. So that shows that, this was just a little bit of a miss in terms of the consolidation benefit and the mathematical addition that we got to do because of the number of days in the first quarter that we got from the benefit. So that's a math behind that growth number. Despite that, like I said in the last quarter, we are trying to meet the 30% number. We have now made a good consolidation in Middle East. That plus the organic growth that we're seeing in Q4, we should hopefully try to hit that 30% number or at least come reasonably close to that.
But organic revenue growth, just quarter on quarter, is I think close to about 0.8% in constant currency terms. Are you anticipating an acceleration, Joseph, in Q4, as Venkat was pointing out? And give us a sense of the demand environment now.
As you know, the Q3 typically tends to be a seasonally tough quarter because of number of working days, people availing of leave, which usually knocks off around 3 to 4% of growth. And this quarter, we also saw a few of our customers in BFSI, which has become a much larger portion of our revenues, having furloughs and forced leaves. So that impacted our revenues. But overall, I think the demand environment looks, as I shared last time, post the election, there seems to be more optimism, and most of our renewals for the year have gone through. We have a pretty strong pipeline based on three factors. One is our GenAI business unit is beginning to see customers move forward, I would say, from POCs to larger implementation. So we have two customers who finished the POC phase in Q3. They've signed larger 6 to 12 month deals for doing production implementations. Our chief growth officer and his team have come together, and we're seeing quite a bit of traction in terms of NN pipeline with 2 or 3, one customer already closed and a couple of them very close to signing. And this team just came together in November, December. So that's again heartening. And the third factor is the verticalization. I think the whole structure and approach to go-to-market has taken root, and we are seeing an improvement in pipeline, both in NN and in existing customers. Overall, I think we are very optimistic about Q4.
Venkat, let me pick on one of the points. That's the generative AI. And correct me if I'm wrong, but did your generative AI business unit see a revenue decline of 4% on a quarter-on-quarter basis?
In rupee terms, yes, we have. It was about 8 and odd crores last quarter, and we have maintained a similar run rate number, 8 and odd crores. That's got to do with conversion of some of the POCs into real projects that are full-blown projects. But yes, we have. It is, I would say, remained flat at about 8 crores over the last 3 quarters. We have done 25 crores over the first 3 quarters of the year.
Do you want to put a number to it? What generative AI could contribute to your top line by the end of FY26? And also talk to us about the 60 basis points margin decline. And do you hold on to your EBIT margin guidance of 20 to 22% for this year and next?
Yeah, as far as the margin is concerned, we are holding on to the 20 to 22%. If you look at the 9-month number, we are at 22.1%. And our margins are, despite the investments that we continue to make into GenAI. GenAI is a startup unit within Happiest Minds today. We are making investments into GenAI. We are making investments into the new sales engine that Joseph referred to. After accounting for that is what our EBITDA number stands at about 21.1%. We would like to maintain it ahead of the 21.1% for the year, and also ahead of the 20 to 22% that we have given as a guidance for the year. So on the margin front, yes, any turnaround that we will see in generative AI business is going to really affect us very positively. As far as generative AI becoming 10%, taking off from where Joseph talked about how we are seeing growth in that business, this generative AI becomes, as we mature, I see that becoming more an integral part of the verticalized offerings that we give. So today, we are looking at offering generative AI into Artha banking services. Going forward, I'm not very sure how I'll be able to split it. There will be an attempt that we made, but what happens is generative AI becomes that differentiator for our products and services to go into the market.
Running out of time, so very quickly, Venkat, are you back to scouting for more acquisitions, since it's been over 6 months since you closed the prior two, and M&A is an integral part of you? And another quick word on your average revenue per customer. Do you see it hitting $1 million mark by the end of FY26, next 12 months from now?
Though not an acquisition, we did disclose a consolidation deal in the Middle East. We have acquired the entire Middle East business of GATS Technologies. This was announced a couple of days back. It was during our silent period, so we couldn't do much of press release and announcement. but that's added to our Middle East presence. Middle East, we are welcoming about 90 plus people in the Middle East market. So that's a reasonably large addition for us because we have traditionally been 100% offshore. And most of those customers are in the BFSI segment and within the IMS SBU. So as you will see, we continue to, keep doing business addition through acquisitions or transfer of business or consolidation. That's in progress. As we look into the new year, yes, we will continue to scout for new deals and raise capital as required as well if it comes to that.
Okay, all right. That is the latest from Happiest Minds at the end of the third quarter. With that, we have to get back to the markets. We have Mitesh, of course, back with us. Let's quickly check what the Nifty has done. Not too much, actually, in the interim. Very, very range-bound, 27 to 28 points higher. The Sensex is flashing just a little bit of red this morning. Mitesh, trades now. I think it's more about individual stocks today than the index.
Good morning again, Surbhi. Yes, I think definitely. But what is also showing good strength is the Bank Nifty. Very nicely set up by about 250-300 points. I think the Bank Nifty could head towards 50,800 and then possibly 51,500. So maybe today financials will do slightly better than the broader markets. I, in fact, have a buy on ICICI Bank, which I would recommend buying with a stop at about 12.59 for targets of 12.95. And, yesterday we had IndusInd Bank. Today I have Indian Bank. That's another stock which is shaping up nicely. Buy in with the stop at 541 for targets of 575.
No, absolutely. And interesting names there. By the way, do you have a view on these OMCs, BP, HP, IOC, anything looking interesting at all?
In fact, they were slightly on the weaker side. And yesterday we did see some recovery towards the second half. They recovered, but I don't have a signal of a trend reversal. Though I think, IOC chart today, there's a gap up opening. Now, if the gap doesn't get filled, we'll at least see a pullback rally to about 132, 133. And above that, I would look at a slightly short-term reversal with targets of 140. So the patterns are good, but then they'll go step by step. So not very exciting to trade.
All right. Mitesh, thank you very much for that. We'll come back with you as far as more trades and more analysis goes. Asian Paints is what we want to focus on. Mangalam is here. Stock's taking a bit of a dip. Mangalam, take it away.
It's the top Nifty loser today, and the reason for that is weak numbers, but even weak commentary coming in the conference call yesterday. So management did say that demand conditions remain challenging in the fourth quarter as well. There is continued stress in urban even as rural recovers. Volumes might improve quarter on quarter, but value growth will take about a couple of quarters to reach low single digit itself. And that's, the sore point that the street is worried about. They've reiterated their 18 to 20% EBITDA margin guidance, but in the medium term, they expect single digit volume growth and value growth led by product mix itself. Brokerage is not particularly happy with that. The stock is corrected about 30% from highs, but still trading anywhere between 48 to 49 times FY26 price to earnings. So Jefferies has an underperformed rating. They're saying that management has highlighted tough demand conditions, as a result of which they've cut their EPS estimates by 4 to 8% as well. Goldman Sachs says that, competitive intensity, which is likely to increase even as demand conditions are subdued, make them prefer the sell rating on the stock close to around 2,200 rupees is their target price. They too have lowered their EPS estimates by 4 to 5%. CLSA is another one which has an underperformed rating. We have Morgan Stanley underweight rating along with Macquarie as well. Macquarie actually is the only one which has an outperformed rating with a target of 2650. Brokerages by and large cutting their estimates on account of subdued conditions, higher valuations despite the stock price correction, and impending competitive intensity.
Okay, all right, got that. Mangalam, thanks for that. That's Asian Paints, down about 4%. Let's move on to Cummins. Makshi is tracking this one. I think there was a conference call. Makshi, what are the highlights?
Well, absolutely. So Cummins Inc., which is the global parent of the company, actually had a conference call yesterday, and three important announcements that came through from the company. The first one is on the guidance. Now, they say that in India, they're projecting revenue, including their JVs, to rise by nearly 10%. The growth is likely to be driven by stronger power generation demand. Now, keep in mind that Cummins, overall, the global entity has several entities in India, out of which Cummins India is the only listed entity. So the 10% growth guidance guidance that they've given pertains to all of these entities combined. Apart from that, they also had some strong commentary on the power gen as well. They believe that revenues in the global power generation markets are expected to rise between 5 to 15% in 2025. They see continued high demand in the data center market, and they're excited about the continued impressive performance and growth potential for the power systems business particularly. And given that, the third comment that they made was around the investments. So they say that they are further expected to raise capacity to meet the rising power generation demand. They're expecting to invest nearly $200 million across US, England and the India manufacturing sites. So overall, when we look at these three major commentary that came through from the Cummins Inc., that is the global parent, it bodes well for Cummins India. It has a positive read-through. So therefore, the stock is up and away in trade today. But also keep in mind that Cummins India is expected to report its numbers later today. So we'll be watching out for that as well.
Okay, all right, Vamakshi, thank you very much for that. Need to take a very quick break. Come back on the other side and all the commodity market action with Banisha Gupta.
All right, welcome back. We got the market, which is absolutely flat now. So actually, you know, that 60 odd point bump up that we had early morning on the Nifty is gone, and we are now down 2 points. Blinking red and green, 23,740. Manisha is here with what's top of mind as far as commodities are concerned. Manisha, good morning.
Morning, and thank you for that. Well, top on mind really is gold prices, because we've been making all-time highs for a fourth straight day today. If you look at the prices right now, we're trading at $28.50 an ounce and above that as well. This is what we've done in last some time, 28% of gains in gold prices in 2024. We've seen prices gain up by 40% if you look at the last 12 months itself. And in this year, 2025 till time, the gold prices are up by 9%. So clearly a lot of safe haven buying is what the gold prices continue to see into that one. If you look at the Indian markets then, and we've opened at an all-time high above 84,000 rupees per 10 grams. Remember, this price does not have GST calculated or making charges. So if you go out to buy gold, you perhaps are already paying around 90,000 rupees per 10 grams there. Well, major buying clearly comes in back of the tariff concerns with the US-China trade war boosting safe haven demand. Gold clearly is the place to be. We also have seen very strong import numbers from China, Singapore, UK and US itself when it comes to gold, and that is reflecting into the markets there. And when it comes to US and China, not so much for US, Mexico and US, Canada, but when you talk about US, China, it does mean global economy. And this is where you have seen buying coming in from various geographies there. Markets also are looking at the China PMI numbers that came in on the weaker side. The offshore yuan also has slipped down, and that means more buying in case of gold. We also are looking at uncertainty in sense of US interest rate cut for 2025. And then it is also about the lower job numbers that we got from US. So everywhere that you see there is uncertainty, weak economic data from US, from China, from European Union, and that has led to buying in case of gold. And not just gold, take a look at the silver prices, and we're trading above $32 an ounce onto this one, which is a 2-month highs. And that chart should tell you on what silver prices have done in the last few sessions there. Well, we have seen the silver prices gain up by nearly 11% in this year already. This is going to be a 5th straight year of deficit in the international markets in sense of supplies. And we're looking at strong industrial demand, retail demand as well. So in this year until now, we are up by 11.5% for the silver prices. It's gained up by 44% in last 1 year. It was up by 25% in 2024 as well. So when it comes to gold and silver prices, there is no stopping. A lot of safe haven buying and a lot of physical buying as well continues here.
All right. Thank you very much, Manisha, for that. Precious metals like silver in focus there. We'll take a quick commercial break here. Market is, of course, flatlined. We are back with our special segment. It's the Economy Latha in conversation with two experts from S&P Global Ratings and BNP Paribas Asset Management. They talk about the first round of US-China tariffs and how they can impact global trade, growth, inflation, and forex as well. Stay tuned.
Welcome to It's the Economy. This is a very important topic now. The tariffs that President Trump promised have been imposed in right earnest, starting with China, while the tariffs on Canada and Mexico have been stayed for a month. The 10% imposed on all Chinese imports stands. China has retaliated with a 10 to 15% tariff imposition on imports of coal, LNG, agri-equipment, pickup trucks and large cars from the US. The Chinese, yuan, which has begun trading only now after the lunar holidays, has actually depreciated. It's depreciated to 7.28, I mean the offshore Chinese yuan, and it was 7.25 before the holidays began. So clearly the impact has been negative. All Asian currencies are also slightly downbeat today, despite the dollar index falling. One would have expected currencies to go up today. That's not how they are. Let's try and understand, where do we go from here? Currency is most important, but also global growth, inflation become important. I have with me two experts, Louis Quist, the chief economist, Asia Pacific at S&P Global Ratings, and Chi Lo, the senior market strategist, Asia Pacific at BNP Paribas Asset Management Company. Gentlemen, thank you very much indeed for your time. Louis, if I may start with you. First, should we understand this as less than we feared? After all, the president has stayed back from going ahead with that 25% on Mexico and Canada. It looks more like bark than bite. And China, which we were told 10%, 60% is only 10%. So do you think we need to fear the tariff war less than we thought before Feb 1st?
Lata, I don't think so. I think the president of the United States has two reasons to talk about and threat with tariffs and to impose them. One is economic, and they actually have laid out already, the White House, a pretty comprehensive agenda. They will go all over all their economic relations with China, Europe, other countries. That will come in due time when we will get tariff imposition because of that. The other is, these non-economic factors like fentanyl, immigration, these kind of things. So what we've seen now, the threats to Canada and Mexico are related to these non-economic factors. Then they have been taken off temporarily. The ones from China are not, the ones that we've had so far are not the only ones. There are also going to be additional tariffs being imposed for those economic reasons. So I would caution against being, optimistic about what we have seen so far.
Okay, fine. I perhaps got misled by the fact that he withdrew the tariffs within 24 hours, or at least postponed them. Let me get to you, Chi Lo. How would you look at the impact on currencies? We saw the initial depreciation in currencies. I mean, the rupee took a pasting, but is the worst behind us in terms of reaction of currencies, or have we just begun?
I don't think. I think at this point it's too early to call for bottom or any change in trends of the currencies. Now, the tariffs by default, by itself, is dollar positive, because with tariff imposed by the US on other countries, one of the easy way for the other countries to fight tariffs is to have their currency depreciate. So I think that trend, other things being equal, still intact. We are still looking at a strong dollar, at least in the short term, against the other currencies. Now, going forward, what it depends, it all depends on how the tariff implementation, the negotiation will play out. Now, if we do see a very serious tariff impact, big tariffs imposed by the US on major economies like China, Europe, and other big ones, we will likely see the dollar continue to go up. But then if negotiation brings down the tariff impact, then we may not see that much depreciation and so on.
Okay. Louis, would you agree that we still have to see a lot of strength? I mean, we saw the dollar go to 110, and then after the tariffs got announced and withdrawn, over the last 48 hours, they have come back below 108, 107 point change at this point in time. But the worst is yet to come in terms of, positive for the dollar strength?
Well, I think what we saw in recent days was, right, that whenever whenever tariffs look likely to be imposed, that strengthens the dollar and weakens other currencies. And so when that reverses, we see some relief for other currencies. But yeah, I think we're not at all out of the woods in terms of that tariff action to come.
Okay. Well, now let me get to the growth and inflation picture. Louis, in the US itself, the fear is that it'll be more inflationary. There are some calculations available. I think Morgan Stanley put out something saying that it'll be 30 basis higher if that 25% had gone on Mexican and Canadian imports. What's your sense? What is the impact for China? What's the impact for the US? And what's the impact for us in Asia, where the expectation is China will dump and therefore it'll be disinflation for us? Your thoughts?
Yeah, so there are indeed a lot of things going on, right? So, I think firstly, it helps to understand that the bigger your economy is, the smaller is likely to be that impact on your growth and things like that. And so, the impact would have been the largest in Mexico. It's a bit smaller in Canada and even smaller in the US itself. With regard to China, the Chinese economy will be hit by those tariffs. We expect growth, to be hit by something like 0.5 percentage points this year, a bit more next year. Inflation, as you mentioned, will be under pressure in that weaker economy, but also, as you said, when Chinese exporters cannot so easily export to the US, well, they will be looking for other destinations for their goods, and that could be within China itself or the rest of Asia. So it will amplify downward pressures on prices outside of the US, including in China itself and in other markets. So there are quite a few things going on over here.
Yeah, we are counting on disinflation for us as one of the perhaps, advantages of this war, one of the few advantages. But Chi, what would you expect will be the impact on growth? Do you think exports of all countries will suffer? Or, I'm trying to gauge the impact for India itself. That's my intention. But you tell me whether you're going to see a fall in global trade and global growth.
Definitely, the tariffs' impact on global trade will be negative. We are likely to see less global trade, more inflation in the short term, but ultimately, medium term, beyond a year or so, tariffs impact is deflationary, which means that the impact on growth is also deflationary, especially for those economies and markets that export to the US, including China. Now, what's important going forward is, from the grand scheme of things, look at the monetary policy trajectory of the major central banks, especially the US, because if the short-term inflationary pressures derails the rate cut narrative that the world financial market is now still banking on, we could see even short-term risk or correction going into risk assets, stock market, and so on. But beyond the short term, if we do see the growth impact, including that on the US, come back to haunt the economy, depressing growth, when that's become obvious, we would see central banks, US, Europe, other countries will go back to the rate cut path, which in turn will help risk asset going forward. So from an investment perspective, short term, we are likely to see correction in risk assets, but then beyond the short term, we may we could see a rebound in the risk asset prices.
How would you define the non-short term? Beyond 1 year, 1 year is short term?
Between half a year and 1 year, that's typically we see the inflationary impact of tariffs on prices.
Okay. Louis, what would you expect would be the US Fed's reaction this year? No cuts or one cut? But more importantly, what's the impact on growth? Global growth takes a hit. Are we going to, for instance, when we are counting Indian growth, would you lower it from S&P?
Yeah, so we are in the camp that expects the impact of tariffs to be pretty negative, negative in the US itself, also, of course, negative for those countries that are facing those tariffs, but then there will be spillover, right? And when country A grows less, it will import less from others. So also we should not underestimate the impact of the uncertainty. You know, if you're a company right now and you're deciding on your investment plans, what are you going to do? You will end up delaying things, and that uncertainty may in the end actually be the largest drag on growth. So all in all, this is definitely a negative for growth. And coming back to that U.S. Fed picture, yes, we also expect that, already in recent months, right, we had to adjust our narrative on the U.S. Fed. When the news about the Trump plans came in, we had to adjust our plans, and we now see already less room for the U.S. Fed to cut its rates, even in the absence of those tariffs. If those tariffs were to actually go ahead, the ones on Canada and Mexico, then we would not see room for any cut this year, and only late next year would then they be able to start cutting again. So that impact is quite significant.
Okay, just a very quick last question. Chi, what's the level you are looking for the Chinese yuan itself? 7.4, 7.5, or even worse?
We are looking at around 7.6 by year end if the tariffs are sustained. But an important factor that we have to monitor is the Chinese policy to stimulate growth in China. If they are successful, we could see a turnaround in investment sentiment, portfolio flows back to China. That could push the CNY US dollar back down to below 7. So we are looking at two scenarios, but base case is going to be more weakness in the short term.
Immediately weakness, yeah, which is why I think today the weakness is reflected on the rupee as well. Although the dollar has fallen, the rupee has also weakened. Thank you very much, gentlemen. This is just a teaser. We will have a longer conversation because I think we will have a lot of reasons for this conversation. Thank you very much for joining us. Have to wrap up on Bazaar. Chartbusters coming up.
Asian Paints slips almost 4% on the back of soft quarter that could be attributed to muted demand conditions, weak festive season. Management in their call said that the demand conditions continue to remain challenging in the fourth quarter. Brokerages cut estimates.
Max Financial climbs more than 3%. The company's third quarter results shows that the new business premium climbs 11% on a year-on-year basis, which is in line with estimate. The company has also announced that it will begin its subsidiary Axis Max Life's listing process once there is clarity.
Angel One rallies 5% on the back of its monthly business updates. The company's client base increases 2.1% from a month ago. Number of orders as well rise 5.5% compared to last month.
Torrent Park climbs more than 3% despite a soft set of numbers in the third quarter. Brokerage firm Motilal Oswal issues an overweight rating on the stock with a target price of around 2,026 rupees. They cite that the subdued core was offset by merchant gains. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Manglam. Manglam, good run in the last few trading sessions. The Nifty is more or less flattish as we speak. But you can feel that the mood is much better because of the broader markets. The breadth of the market is fairly good.
Yes, Nigel. No matter how high we go from the Nifty here, the good part is that the street